Hey guys, and welcome back to another episode of Trading Indicators Explain, where we go through eventually all of the common trading indicators out there and we talk about the pros and cons and the benefits and the drawbacks of each one and how you can use them to better your trading. Today, as you can see on the screen, we're going through the exponential moving average. Last time we went through the simple moving average, and if you're interested in the entire playlist for all of these things, the link is going to be under the video, along with a discount code for trade ideas to save yourself a couple bucks there if you want to try out scanning for and auto trading and charting and all the things that trade ideas can do in and around these indicators. So first of all, with the exponential moving average, let's take a look at the math. We talked last time about how a simple moving average was just the average price over whatever period of time you chose for. So example, if you're using a 10 period moving average, the value of that indicator for that day will just be an average of the last 10 trading days. That's all there is to it. So an exponential moving average, we basically weight more recent price action a little bit higher than prior price action. And that's your main difference, is that during normal markets and slow markets, they're going to be about the same. And as I show here, during gaps and large price movements, an exponential moving average just adapts a little bit quicker to that price movement, that price change. So here on the chart, you can see this blue line is the 8 exponential moving average, whereas the gold or the orange line right below it is the 8 simple moving average. They will be a little bit different until about 8 candles, where they'll start to line up pretty similarly again. So charting with trade ideas, you can chart exponential moving averages. You currently can't scan for them, but we'll talk about some things you can do to get around that and help out with that kind of later on. So we'll go into the charts right after we're done this. But first, what are some usages? So just like the simple moving average, one of the main ones are when price crosses a moving average, you can use that as an entry signal to take action on maybe something you have a fundamental catalyst for, or you're looking at a longer term chart or whatever it is. It probably wouldn't be profitable just to enter and exit every time price crosses, but there is some advantage to adding this to a trading repertoire the same way you would with the simple moving average. So the main thing to look at here is that you could use it as support and resistance as well. You can see PACB, the same chart we used from the other example, because it works the same. Pulled back here, and you could have initiated a buy as that moving average held as support, and then sold as it crashed through. A great way to keep you on the side of the trend. So another way to look at it is a moving average crossover, and this is kind of the most simple system that most people start with, and then layer on other things in order to make sure they're not getting whipsawed a lot. But you can see here on the chart of Apple, there is some times where a shorter term moving average will cross below a longer term one, and that would signal a sell. And when the moving average crosses above the slower one, it would indicate a buy, and then a sell back at the top of the chart. So let's go into here our live charts. So one of the main things I wanted to show you here is that if you take a look here at Apple, you can actually see, if you monitor my crosshair, how again we have an 8 EMA and an 8 SMA plotted on this chart, and for most cases they're pretty similar, right? There's not much of a variation. The only time they change is whenever there's a large price movement, a gap or something like that. You can see that the blue average catches up a little bit faster, but the orange or the simple moving average is a little bit smoother. So, the first thing I wanted to talk about when it comes to scanning with these is knowing that they're pretty similar, right? There's no sense in saying I can only use an exponential moving average for my trading, where in most cases these things are going to be incredibly, incredibly close to each other. The second thing is that you notice that because the exponential moving average, it catches up quicker. My suggestion is, if you're looking to scan for, say, a 10 period exponential moving average, try looking at the 8 simple moving average, right? Try always looking at the more short-term moving average and see, because in a lot of cases that will be very, very similar to a 10 exponential and an 8 type of thing in these fast movements, and then for the rest of the time they're going to be the same anyway. So again, just showing that there's nothing magical or special about these. It's just, this is the way that they are. So again, that's another one. I'm going to hope to come out with these once a week. One of the main reasons we're doing this is because as with trade ideas, we're going to start programming in a whole bunch of new indicators. So you're going to start seeing on your system new indicators coming in all the time. And I want to make sure we have these kind of reference and educational videos for them. So again, I will see you guys in the next one.